Hello, everybody. Welcome back to the Market Information Lab Valuation Bootcamp. This is week 4, and we are covering comparable companies and precedent transactions. My name is Jacob, and I'll be the teacher for today. Let's go ahead and dive into relative valuation. So just a quick overview of where we have been and where we're going. So we have done Intro to Excel, talked about the financial statements and financial topics. Today is the first day we'll actually be covering real valuation. So we've built on a couple of these core principles, whether it be the financial statements, the topics we'll use in these in the valuation, as well as some Excel keyboard shortcuts. Hopefully by this point you're very familiar with Excel, or you're becoming pretty familiar, and you're able to follow along quite quickly when we actually do these Excel exercises for today. Overview for our agenda today will be, we're going to touch on what valuation is a little bit more intuitively. Then we're going to dive into comparables and precedent transactions. We're going to actually skip over the Cap IQ class for the sake of time. So if you have not taken our Cap IQ class, I recommend pausing the video here, going and taking our Cap IQ class, because we will not be going deeply into Cap IQ. However, we will be using it in the exercise. So if you have not done the Cap IQ class that we teach at the mill, please pause the video here, go back, take the class, and come back to this video. We're not going to be diving into Cap IQ today, but it's extremely important to learn for just your valuation's sake and learning how to build out these valuations. It's a great tool that we'll be using today. We're not going over how to use it, but we will just be diving into it with the Excel plugin. So please pause the video, go back and watch that. Do the class, the Cap IQ class. It's a great class, and make sure you put an emphasis on the Excel plugin. Then we're going to be using the Excel plugin to fill out our valuation model for Chipotle. Chipotle will be the company that we're valuing and building a model for throughout the next couple weeks. So here we go. Without further ado, we're going to dive into valuation. Valuation overview. What is valuation? So valuation essentially is the process of finding a price or determining the value of a company. And it doesn't have to be a company, but in our sake, we're focused on company-specific valuation. And the big value that we're paying attention to throughout the whole process is enterprise value. Now, enterprise value is the value that is attributable to all stakeholders. So this includes equity, debt, employees, etc. All of the stakeholders are represented in enterprise value. That's very important information to know. There are two main types of valuation. So today we are talking about relative valuation, which means we're valuing it compared to other comparable companies or comparable transactions. Next week we'll learn more about intrinsic valuation, which is to value a company based on the intrinsic cash flows, or things that are unique to the business. And the main types of relative valuation that we'll touch on today are comparable companies analysis and precedent transactions. We're going to dive a little bit into the pros and cons of intrinsic and relative valuation. One thing to focus on here, since we're talking about relative, is the pros of relatives. There's very few assumptions that goes into relative valuation. For example, the only assumptions you have to make are the set of comparable companies that you believe are comparable to the company you're trying to value. There's not a whole lot of assumptions that you have to make. You're just taking what the market sentiment is around these assets, these comparable assets, and you're applying it to the thing you're trying to value. Which leads to our second pro, which is very fast and simple. Some of the cons is at times it can be very difficult to find a truly comparable company or a transaction that is truly comparable. This often makes us look outside of the box, or maybe include more transactions than we would have liked. That way we can get and triangulate around a truly comparable value. Another thing that we focus on is the multiples are often determined by the market psychology. At the recording time of this video, coronavirus and COVID-19 is at large. We are currently seeing the impact of COVID on the greater economy. So all of the multiples and the relative valuation have seen a significant decrease in value just due to the market sentiment. Whenever we're looking at relative valuations right now, we're probably adjusting the value that you're deriving based on the relative valuation, based on probably a moving average before this whole thing happened. That way you can um, price out some of this increase fear in the market psychology. So, just to highlight quickly about intrinsic valuation, we'll go deeper into this next class, but some of the pros are it's more specific to your company's performance. As we talked about, not every company has a truly comparable set of comps. So if you're doing intrinsic, you're able to truly reflect what you think is going to happen in this company. It's not dependent on the market price or fluctuations, and a lot of times you have the ability to toggle between scenarios. Next, some of the cons is very reliant on assumptions. Now, the assumptions is a pro, but can also be a con. You can use these assumptions to manipulate the value you're deriving for this company, and quite honestly could get the DCF to say whatever number you would like. Next thing is it's extremely difficult to forecast some of these assumptions. For example, no one predicted this quarantine or COVID-19, and your DCF most definitely would not have included this last year. So it's almost impossible to truly predict what's going to happen. So you have to use your best guess or best assumptions and put your best foot forward, and know that these are going to be very different, but you're just trying your best to approximate value when you're doing intrinsic. So relative valuation is much more focused on performance across a group of assets. It's not super specific to your company, but more towards what is the value of the group of companies. So in this group of companies, what is a value specific to the size and the performance of your company? So for example, if you're taking tech stocks and your company is extremely high growth, what is the value of a high growth tech stock that has your margins, your growth rate, and your performance? That is essentially what relative market valuation. Additionally, it also takes into things such as industry. Whenever we're doing relative valuation, one thing that we like to focus on is benchmarking. Benchmarking is extremely important because it shows how your company performs against other companies in its set on the basis of margin, growth rates, etc. So these things are extremely important. And whenever you're actually presenting a comp set, you want to make sure that your company is performing in the higher echelon of the metrics such as margin and growth rates. You don't want to present a comp set that says you're the worst company in the comp set, because that probably means you didn't make the right comparable company set. And then based on your benchmarking, you can see whether if you want to use what type of margin. So if your company is the best company in the set, then you may recommend using the higher values that are coming out of your relative valuation instead of using some of the median or lower end values. One other thing that we like to use in screening criteria is you will use a mixture of qualitative and quantitative data. So as far as qualitative data, you're looking at geography, such as location and headquarters, industry, so what market and who are their customers, and finally products. As far as quantitative go, you'll look at size, margin, and growth rates to really triangulate around company. For example, it wouldn't be fair to compare a Tesla, which is a high growth automobile company, to a Ford, because Ford is a lot slower growth, a lot larger than Tesla as far as production and who their end customers are. So this is kind of what we were talking about here in the next slide. As far as relative valuation, it's important to really focus on who your industry is and what the metrics that are driving this. If a market's growing very fast, a lot of times you'll see a higher multiple because investors are putting a stronger emphasis on the potential growth in that market. It can be a lot more difficult to compare, let's say, a stock that is dealing with software or technology to an industrials, just because the growth potential and the potential for earnings in the long term is much more different. Another thing that you can look at is the business model. For example, two companies can be competing in the same industry, but one has a much more heavy asset model versus a model that maybe outsources or uses a lighter asset model. So for example, it's tough to compare automobiles, which is very asset heavy, with maybe a distribution company that runs a little more light on the asset. Both companies are in the industrial sector. However, an automobile has a lot of PP&E, whereas distribution is probably quite low on PP&E. Multiples, again, they're very impacted by macroeconomic changes, so definitely keep that in mind. Here is a really great example. Not only within the automobile industry, you see the difference between the average automobile and the average technology. So you're looking at between 5 to 10 to 15 times in the automobile industry versus technology. You're kind of looking at anywhere between 15 to 30 times. As you can see, it's not very fair to compare from automobile to technology, but even within the certain subsets, automobiles and trucking is right around 10 times, and making of auto parts is 6x. So as you can see, even the multiples within the specific automobile industry make you really get down to what determines the value of and what is truly comparable. Whenever you're looking at these sets, it's really important to focus in on these things. Comparable companies. Essentially what we're trying to do in a comparable companies set is look at the current public companies out there. And the reason that we want to look at public companies is because this data is disclosed on to the SEC or to the governing bodies, right? So if you're a public company, you're required to send out all of this data, this information, as far as your profitability, and you're currently being priced based on the market. And then we're going to take certain metrics such as market cap, debt, preferred equity, and EBITDA to drive down to a valuation. Essentially, what you most likely will do is take EV over EBITDA or EV over some metric, and then you apply it to your company by multiplying by your target company's EBITDA. A very simple approach to valuation. However, it can be quite complex based on trying to pick the right companies in the screen. So here's an example of maybe what you would do whenever you're trying to select some comparable companies. One is you want to triangulate on the right industry. For example, we talked about tech and automotive, but maybe you want to even get more specific. Maybe we're only looking in auto parts. Then you want to go to geography. It really wouldn't make a whole lot of sense to compare a North American company to a European company, since the clientele and the types of cars may be very different. Then we're going to drive down to size. For example, we wouldn't want to compare a $10 billion company to a $5 million company. There's a lot of difference as far as profitability, access to vendors, as well as who they're selling to. Finally, we'll want to kind of triangulate on things like performance, such as growth and margins, and then we can look at other things to maybe slim down our selection criteria if you have too many. Oftentimes you'll see adjustments. Some of these adjustments usually come from only having a smaller set. Let's say you find 2 or 3, you may have to broaden your search criteria to get 5 or 6. Another thing that's important is whenever you're adjusting for these companies, you want to adjust their current financials based on one-off transactions to make sure it's truly apples to apples. For example, if there's a restructuring charge in somebody's financials for the last year, you'd want to adjust this out so that is no longer being impacted on their EBITDA. Because you're adjusting this out, it allows you to truly compare apples to apples versus having all of these small one-off charges and not really being able to triangulate on true value. This has really gone into much more deeply in Fin 463, which is investment banking. I highly recommend taking this course if this is something that's interesting to you. Precedent transactions. Precedent transactions is essentially the same process. However, whenever we're doing M&A valuation, we always do a precedent transaction screen to make sure we understand the true value of buying out the company. Now, one thing that's different about precedent transactions is that the value is not fluctuating. For example, your comparable companies analysis may value fluctuate between the term of the deal. For example, when you start the deal, your comps may be traded higher than at the end of the deal. This is important because they're always being traded and the market is always pricing to update them. However, your precedent transactions are locked in place as soon as the transaction goes through. Usually, to get around this, we want to focus on more relevant and recent transactions to make sure we understand and capture the current market sentiment around deals. So, usually you look within the last 3 to 5 years. This valuation approach is extremely quick as well. You're just taking the value, so EV, and then you're taking it over some sort of financial metric and applying it to your company. Another thing within precedent transactions that we need to focus on is the control premium. For example, you usually will see a higher valuation come out of precedent transactions because it costs more to take full control of the company instead of just taking it at its current market value. Some selection criteria. One, you'll want to focus on industry again, geography, size, performance. The last thing that we're going to focus on is time, right? You want to make sure you're screening by the last 3 to 5 years. Now here's kind of where valuation becomes an art and a science. Whenever you're doing precedent transaction, oftentimes you'll really be able to find only a couple of transactions, or you need to look more closely around who your ideal buyer is. For example, if your buyer universe is more private equity focused, you're probably looking more towards financial sponsor deals to use in your precedent transactions. However, if you're trying to sell to a strategic, maybe you want to focus on more strategic acquirers. Again, there's no right or wrong answer, but sometimes if you can maybe tailor your values up or down based on your output. For example, you may include a higher value deal just because it can bump up your value of the company instead of using a lower value deal. The last thing we'll kind of talk about is really thinking about what makes the company tick. As far as Ferrari goes, a lot of people would think as Ferrari as a car manufacturer company. However, when this company IPO'd, they used a lot of luxury brands to compare and price it. And this is because the same people that would buy a Ferrari are the same people who are buying luxury goods. And the way that you acquire customers is very similar to a luxury good manufacturer. Now, like I said, we're not going to dive deeper into Cap IQ. We have a great Cap IQ class. I recommend you go over and watch that instead. We're going to just skip to the Excel exercise for sake of timing. However, if you are new to Cap IQ, we recommend going over to that class to learn a little bit more. Okay, so for today, we're going to go ahead and build out a comparable company set and precedent transaction set based on some already selected comparable companies for Chipotle. We're going to find the relative multiple and arrive at the valuation range. So please pull up the Excel exercise for today. Alrighty, so as you can see, we already have 5 companies pre-selected for our comps screen, as well as the company we're trying to value here at the bottom. Again, we're working in Excel, so I highly recommend trying to use your keyboard as much as possible. So hopefully you've already watched the Capital IQ class and you know all about using the screening tool as well as the plugin. So we're going to go ahead and use the plugin here. So what we want to do is pull in the revenue and EBITDA for these companies. So the first thing we're going to do is toggle to the formula builder. One thing to note about the formula builder, it seems like there's a current bug in the system, so you have to do Control N to open a new Excel and then exit out. So Control N to open a new one, a new Excel spreadsheet, exit out. Then you should be able to open the formula builder. Another thing about the formula builder, we want to be hovering over where we want our first formula to be entered. That way we can simply just drag and drop. So formula builder, again, my identifier, we're going to do cell, and then I'm going to click my ticker, so A7. And then we're going to search by data item keyword, revenue, total revenue. And then I want my period to just be relative last 12 months. Now we talk more about what last 12 months means in our Cap IQ class, so feel free to go over there if you are lacking any understanding there. I'm going to go ahead and add formula, and the next thing I also want to do is include EBITDA. And again, I want that to be last 12 months, add formula. Then I'm going to click OK. And as you can see, I have dropped in the revenue and EBITDA for El Pollo Loco in the current last 12 months period. Now I'm just going to simply highlight these two, shift down arrow key, Control D to drag these formulas down and get the revenue for each of the prospective companies. Next, I'm going to fill in the required information for valuing the company. So I'm going to pull in market cap, net debt, preferred equity, minority interest, and enterprise value. So if you add all four of these things together, you will come to our enterprise value. One of the things we want to focus on is making sure that these 4 items add up. We're going to go ahead and drop in market cap here. So we're going to, again, pop open the formula builder. My identifier, I want it to be cell A7. I'm going to type in market capitalization, grab market cap, and then market cap changes day to day. So I'm going to grab as of date cell A3, and I'm going to click F4 to lock this cell. Since when we drag it down, we don't want this to drag down respectively. Add formula. Going to grab net debt. We want this as of last 12 months. Preferred equity. Total preferred equity. Add formula. And minority interest. Minority interest. Again, want this as the last 12 months. Add formula. Okay. As you can see, I just dragged in all of the important information for calculating enterprise value. I'm going to copy this, and I'm going to just shift down arrow key, Alt ESF, paste special formulas. As you can see, as I dragged it down, because I locked cell A3, it is always going to be pricing as of the date in the top-hand corner, and the date in the top-hand corner is always going to be updated with today's date by doing the equals today's function. Last thing I'm going to do is add up my enterprise value, which is I'm going to do Alt equals, and then sum of market cap, net debt, preferred equity, and minority interest. Closing parentheses, copying, and pasting this down with Alt ESF. So quite quickly, using the Excel plugin, we've already filled out this comparable companies Excel spreadsheet very, very quickly. Hopefully this shows you just kind of the power and the importance of using Capital IQ whenever we're building out a comparable company set. So now we're going to go ahead and calculate our relative metrics. So EV over revenue and EV over EBITDA. So what I'm going to do is take enterprise value and divide it by revenue, and enterprise value divided by EBITDA. I'm going to copy and paste these down, Alt ESF, using the keyboard shortcuts we've been using throughout this whole entire time. And as you can see, now we have the relative metrics that each of these companies are trading at. Now I'm going to go ahead and calculate some mean and median numbers for each of the multiples. So mean, I'm going to take equals average of the set. And then median, I'm going to do the median function. Now, if you're actually building out a valuation, you may also want to include the first quartile and third quartile. I'm going to just copy and paste these formulas to the right. And now I have the mean and median for the company set. Last thing I'm going to do is I want to copy and paste these formulas down to get Chipotle's current market pricing, as well as revenue, EBITDA, and their enterprise value. Next, I'm going to just divide their revenue and EBITDA, Alt ESF. And as you can see, they're traded extremely high compared to the market. They're well above the median and the mean on terms of revenue and EBITDA. So because Chipotle is a publicly traded company, we can calculate these metrics. We can use this value. We can look at the market and kind of see where it trades amongst the market. So, the market clearly believes that Chipotle is better than the comp set based off the market valuation, and we could do more benchmarking analysis, compare the margins and growth to further that analysis to determine why the market thinks it's so valued so highly. However, for today's sake, we're just going to assume that Chipotle, we're just going to use the comps value to determine what the value is. A lot of times a comps analysis around Chipotle often will lead the layman investor to think that Chipotle is overvalued. Now that's kind of up to your own interpretation, but Chipotle is extremely highly valued as a restaurant brand. That is indisputable. So if you're actually trying to look towards whether or not you should invest in a company, a comparable company set will just show you, is this undervalued or overvalued? Is the market overvaluing or undervaluing this? As far as Chipotle goes, it's extremely overvalued compared to its comp set. So you may think about shorting the stock if you believe that the market is wrong in pricing Chipotle so highly. Now we're just going to go ahead and apply the revenue and the median revenue as well as the EBITDA, the median EBITDA to determine our value for Chipotle. So if we were just going to take the revenue of Chipotle, which is the metric, right? So we take the metric and then we apply the multiple, EV over revenue median. So we take the value that our comp set provides us, and then we multiply it by our perspective intrinsic value. So our perspective revenue, how much revenue is Chipotle doing, and what is the multiple that we should be applying to this revenue. This will then give us our value for what we think Chipotle should be. So just based on the median EV to revenue multiple, Chipotle should be trading right around $10 billion. However, it's currently trading at $30 billion. So you can see that based on just a revenue multiple valuation, it's extremely, extremely high. And this would definitely lead an interested investor towards the path of thinking that maybe Chipotle may be overvalued. Next thing we're going to do is going to apply EBITDA and the EV over EBITDA multiple. So, again, if Chipotle was just a private company, it wasn't being currently market priced, we would assume based on the EV revenue or EV EBITDA multiple, we'd assume that the enterprise value should range between $13 billion to $10 billion. This is without any benchmarking. This is without any adjustments based on how it's performed. So this is important to keep in mind. However, this is definitely leading us to think like Chipotle may be overvalued just compared to its comp set. Again, we haven't done any benchmarking. We don't know if it should be overvalued compared to its comp set, but this is just what our initial analysis is leading us to believe. So this is, again, why you want to come in to a valuation exercise with predetermined ideas. So if you were just to look at these numbers and say, oh, Chipotle is overvalued, short Chipotle. If you did this, you may be missing the underlying reasons why Chipotle is so much higher valued compared to those other companies. And if you look further deeper into Chipotle, you may realize, wow, Chipotle actually is undervalued to my assumptions or my beliefs on like where it's going to go. So it's extremely important to come into a valuation exercise with some conviction around or some thoughts around whether what this company should be valued at, and do the numbers support your ideas. So if you came into this exercise with Chipotle is overvalued, it's very, very easy to leave with these numbers and have some strong conviction around why it's overvalued. And for example, it's overvalued compared to its comp set. That is a great rationale for moving forward with this analysis to continue to determine if it's over or undervalued. So hopefully you guys were able to follow along there. I know that this can be kind of tricky whenever you're using it for the first time. Essentially what we're doing is we're taking a financial metric, usually revenue or EBITDA, dividing it by enterprise value, or dividing enterprise value by the metric to get a multiple, and then applying that multiple using our company's specific metric. Now we're going to move on to precedent transactions. So as far as precedent transactions go, this is very similar, except this is never being price updated. So these are deals that have happened in the past, and we were not going to ever update the price because this deal transacted, and this is the set price. This is really nice because you don't ever have to go back and update the prices as you begin to build out your valuation pitch deck. Moving forward, We're going to continue by filling out the information for these 4 deals, and then we're going to similarly use the multiples that we have determined from this valuation and then apply it to Chipotle. So if Chipotle was to transact, where would we see this range? Excuse me. Moving forward, the first thing I'm going to do is pull in Chipotle's prospective revenue and EBITDA numbers, just so we have them whenever we're applying towards our valuation. So equals control page up, and I'm just going to grab revenue. I'm going to equals control page up, grab EBITDA, and equals control page up to grab my current enterprise value. This is just making things much more simple whenever I'm going to compare at the end and determine whether my valuation supports the ideas that I had coming into this. Now we're going to go ahead and drop in the new transactions. Another thing to focus on here is, there's not a whole lot of deals that occur in the restaurant space. There's not a whole lot of companies that are restaurants at the size and scale of Chipotle, as well as like kind of the business model, right? There's only a few companies that sell, that the burrito bowls or the burritos, for example. So it's really hard to triangulate on a truly comparable precedent transaction set. So we did the best we could with these companies. But one thing to know is maybe as you go into this, it's like a caveat to using a precedent transactions analysis is you don't have a truly comparable set when it comes to restaurants, just due to the limited amount of companies at that size and scale and scope. We're going to go ahead and fill in all of this information using the CapIQ plugin. Again, I'm not going to show you how to use a plugin. If you need to learn how to use this, please reference our other CapIQ video. First, we're going to pull up the formula builder and go to transactions off to the right-hand side. We're going to be grabbing cell A7 for our identifier, and then transactions, we're going to get general transaction details, and then we should see announcing / initial filing date. We're going to add formula here, and then we're also going to grab the buyer investor name, add formula, and then our seller name, add formula. I'm going to add formula here. Oops. Okay. And don't worry, there's not a problem here. There's just a lot of buyers for this one deal. There's a lot of sellers for this deal. So I'm just going to go ahead and format by wrapping the text. And I'm going to center all of this data, Alt-H, and then you see AM. Now we have this data is centered, and I'm just going to adjust this so it looks a little bit better. Nice. Now we're going to go ahead and drop in the transaction value, revenue, and EBITDA for these couple deals after dragging the information down. So as you can see, we have now the buyers and the sellers of these target companies, and everything is formatted very nicely after we centered within the cell and wrapping the text, so we don't have this long string of text that is cut off. Alrighty, now we're going to drag in the transaction value using the formula builder. We're going to go to M&A and then offer date / values, and M&A features is where we'll be taking this out of. First thing we're going to grab is implied enterprise value for the identifier cell A7, add formula, and we're going to go ahead and scroll down to the current, the target LTM financials. We're only focused on the target and their financials at selling point. So you have revenue, add formula, EBITDA, add formula, and then we're actually just going to leave this enterprise value column blank. I'm going to click OK, grab this data, drag it down, and now we have a full filled out precedent transaction set for all of the target companies. Now it's time to calculate our EV and over revenue and EV over EBITDA, apply this to Chipotle, and then analyze our outcome. Pretty simple here, dividing transaction value by revenue and transaction value by EBITDA. So I'm going to quickly adjust this. So this is in the middle, Control C, Alt ESF to drag this down. And then again, I want to make sure that all of our numbers are in line. So in the middle, so Alt H, AM. Oops. Nice. Now everything's correctly formatted. We're just going to drag in our median and our median. So equals average and equals median. Always using tab to pull up the actual format or the formula when you're in that formula window. Control C, Alt ESF. Using our keyboard shortcuts we've been practicing throughout this time, you're able to move along with the actual analysis quite quickly. Now we want to apply our revenue number and our EBITDA number to the median multiple. Again, we have not done any benchmarking, so we don't know if using the median makes the most sense here. But we're going to go and do that anyways. And as you can see here, if you're looking just on a revenue basis, Chipotle is not as overvalued as the comparable companies analysis recommends. The deals suggest that companies should be valued a little higher based on its revenue, looking at 4 times in comparison to roughly just under 2 times for its currently trading metrics. Now, a lot of this may be dealing with the actual acquisition premium, like what it costs to buy a company, like the premium over a comparable company set. Another explanation may be just the current downturn has been extremely harsh on food and beverage industry. Not a whole lot of people are going out to restaurants, so that may have impacted the valuation between kind of your precedent transactions and your current comps data. So your precedent transactions is definitely recommending a much higher range than your comparable companies. So this is something to know that range may be attributable to 1, the control premium, and 2, maybe the market sentiment. But that's all that we have for you guys today as far as the Excel exercise. A couple key takeaways is 1, as we begin to focus more on valuation, we need to know what is the difference between relative valuation, and that is you're basically pricing a asset based on what has happened in precedent transactions or what the market currently believes these assets should be worth. Second, we understood how to kind of create a comps analysis in Excel, and if you have gone and you've taken our Cap IQ class, you also know how to build out a screen, how to find some of these companies. Then we're looking at being able to find enterprise value from relative valuation, right? So taking the multiple that we determined from our range, from our median, for example, applying that to our revenue or applying that to our EBITDA to derive a value for Chipotle. Next week we're going to look a lot heavier into intrinsic valuation and starting to look at some of the cash flows and how those cash flows can be applied to determine the value. Thank you everybody for coming. Looking forward to see you guys next week when we talk about DCF. Thanks.